Now let's move on to the commentary.
Yeah.
What do they think?
It seems like we've been telling the same story for about 2 years already. It's this same story. It's this idea of what I said before, the multifamily snapshot doesn't look great, but the future looks promising for investors.
And what does that mean? Tell us what that means.
It means that according to the trends, particularly the supply trends, it meant for the past year and a half, 2 years, we were looking at a situation in which rent growth was shrinking, in which expense growth was growing, and yet at the same time there was never a complete cynicism or pessimism among investors. Investors still saw a future, still saw a finite end to the supply wave, and they also found they had hope for further rent growth. They thought that maybe expense growth would go down, like we said, maybe inflation's going down, maybe expense growth will go down, and ultimately the fundamentals of apartment demand and housing demand as greater than any of these things that we've listed. That's kind of fueling this long-term thing. Now, that's been a story forever. And I wonder, of course, how long have we been saying this? Maybe 1.5, 2 years. But what is different? I'll argue that these skies that are cloudy, these aren't the same clouds. Maybe the same weather pattern, but they're not the same clouds. We're in a different part of this weather pattern, different part of this story that's been happening. And what has been happening is, as we've progressed, it went from, oh man, we are facing the greatest surge of apartment supply that we've seen in a generation, and now we're kind of on the other side of it. We are just past the crest of the wave of this apartment supply, whereas at any point in those 2 years before, we were still struggling. We could see the end, but it was a long time coming. Now it is clear that not only are we going to see an end to this apartment supply, we're going to see an end to a high interest rate environment, and all throughout, even during the darkest moments of for multifamily investors, you could take solace in the fact that housing demand never really dipped down. There still is housing demand, and as this report notes, specifically apartment demand, there's some promising demographics. For over the next 10 years, we may have a solid supply of elevated apartment demand. Solid supply of demand? Well, yeah. A solid supply of renters, that is, people in peak renting years over the next 10 years.
So, Matt, on just comparing the Fannie Mae commentary with the CBRE survey, one thing just to note is, they're saying that, multifamily property values still declining, and they're using MSCI data for this. Now, MSCI on the most updated survey that we covered here on the Gray Report not too long ago actually showed that cap rates were starting to decline a little bit after kind of flattening out. I'm curious if they're looking, if some of this data is a little bit kind of looking in the rearview mirror a little bit. That was also very high frequency 1 month of data, so maybe they're just kind of discounting it.
How long did it take them? Is it taking them to process our documents at Gray Report? This is probably a very old data. Maybe they started this 4 months ago, because it does seem like the latest month that they have here is March 2024. So they're maybe a few months late when it comes to the real-time data here.
I think that's exactly right, Matt, that it is just good enough for government work.
It's good work, but it's... Listen, you can have fast, you can have good.
Yeah. But it's interesting here, in some of the rent growth forecasts and even cap rate forecasts, going back here, they're basically saying that we're going to get back to an organic rent growth level that's higher than really the 4 years prior to the pandemic. Really not a level had not seen since a peak in 2015. And they're showing that essentially going to level off around 4%, seeing a lot of demand for apartments with limited supply. Really, that growth should kind of kick off sometime into 2025, according to them, and really a convergence across A, B, and C classes. And then also, Matt, on cap rates, on their forecast, if I can, there we go. They've got a base case of downside and a severe downside. But their basic assumption is that, we're going to be on a little march downward in cap rates, with a projection of cap rates being, at 5% or below, sometime kind of in the 26, 27 time frame.
Yeah.
My gut is that we're going to be at 5 caps for an A-class property today or next week. We're already there.
Yeah.
I believe in a good market, good location, Class A, you're in the 5. Now, what the challenge is, 5 cap rates. There's a time component. Are you taking that? Because again, the way that cap rates are calculated is you take the net operating income of the property itself. That's your main variable. So net operating income, how are you going to calculate that? So you have a couple different options. The most traditional way is you using the last 12 months of financials.
Mm-hmm.
Taking just 12 months, P&L statement. What's your net operating income? But a lot of folks, what they'll do is, for good and bad reasons, is sometimes, if you say, hey, we had a problem with the property a year ago. It took us 6 months to figure it out.
Mm-hmm.
And the property's performing incredibly today. We've increased rents by 20%. We've reduced expenses.
Yeah.
So, if you buy it on a T12, you're going to have a blend of that performance. Now, as a seller, I'm going to say, yeah, no. But you're not buying, because when you're buying commercial real estate, you're buying an income stream.
Yeah.
You're buying a piece of property, you're buying an income stream. They're saying you're not buying that income stream. You're not buying this, a year ago's income stream. You're buying this last 6 months.
Yeah.
And that's going to continue forever.
Was it like the summer months, spring and summer, or was
that's the thing. So like a lot of brokers, real estate brokers, they'll give you cap rates relative to on the T3 or T1.
Right, in like peak renting season.
Yeah. Because on a T1, it's like, hey, look, we've had our best month of all time, and we think we're going to keep growing here. And if you put a cap rate on that, all of a sudden it's a 6.25.
Yeah.
But if you take the whole year, it's 4.97.
Yeah.
And so you have to ask yourself, okay, is this an anomaly? Or are we just hitting peak, occupancy, peak renting season, and then it's going to be all downhill, and maybe I'll get back to there eventually over time, but it's going to take years to actually get a full year of that type of income.
Yeah.
Sometimes you want to mess with like what the T12 is, because expenses, you might use like T3 income and T12 expenses.
And you might be able to adjust it seasonally. Like, okay, I know it's the winter months on these in here, and we can figure that out. And,
that's why a lot of times they'll do like, all right, T3 income, but T12 expenses.
Okay.
So it captures all of the ups and downs on the expense side, and maybe there hasn't been as much annual variability on the expense side, but like the story here is on the incomes. So what I'm saying is that there's a lot of different ways to calculate.
I do think it's interesting.
Cap rates.
This cap rate forecast does seem the way it's kind of stair steps down. It's like, well, they expect a rate cut here and here and here and here. Now, what I would say is there's probably going to be more excitement on the first few jumps than the following ones as people see this trajectory.
I think that's a really good point, Matt. Now, like that, I think there probably will be a nice push down, and then like the slow crunch and compression. But we shall see. Only time will tell.
And even apart from, so we're looking at their forward things, and again, the report was very much like a snapshot versus the future, and their snapshot did talk about how vacancy is expected to grow through the end of the year, how concessions are inching up, but there was some promise. And one of the most interesting things that I've noted here, just referenced before, is the demographic picture, and it is I'll just give the quote here. It says, as seen in the chart below, the size of the nation's 20 to 34-year-old cohort is expected to remain elevated over the longer-term forecast. That is a very favorable trend for the multifamily sector in terms of ongoing demand, since this group of people is most likely to rent a multifamily unit. Many multifamily investors are aware of this trend and continue to show interest in the sector. And that's where it does seem like I'm telling the same story for 2 years, but I do think that people are listening. It's just very sharp. It's a very sharp contrast between the people that are in the industry and out of the industry. The people that are out of the industry maybe telling the story of 2 years ago. But there are people that are very much aware of this. There are people that are very much aware of the idea that maybe cap rates have peaked, maybe values have bottomed, and they're on the way up. As paradoxical as it looks, it's because people are not looking at the cloudy sky snapshot. They are looking at the forecast for, sunny days ahead.
And not to say that, we had a crystal ball or anything. Although, man, I did think it would be interesting for the show if we did get a crystal ball in here, just for fun.
Yeah.
But
a magic.
What were we talking about 6 months ago, Matt?
It was very similar.
We were talking about how if you want to get good multifamily assets at good prices, you better buy them now because prices are going up.
Yeah.
Right around the corner. And you better do it before they hint at lowering interest rates.
Yeah.
And what happened? Well, it was hinted at.
That's good. That's a good point, because I kept
go run the tape.
As I was writing the notes and as I'm talking about it now, I keep thinking, all right, what has been different? And we've outlined things that are different. The certainty of the interest rate cut is a lot clearer. We're on the other side of the housing supply, and so there's so many things, and we have been tracking it as much as it has felt like we were saying the same story. Back then we were saying, hey, it's going to happen. 2 weeks ago it's like it's happening, and then today we say it's happened. Yeah. So this is where it's going, and it may seem like, I'm sure in 2 months from now, we'll read some Wall Street Journal articles and New York Times articles saying, hey, it's possible that the multifamily market could really start to take off. Who knows? And by then it'll be too late.
Yeah. I think we got to get through one or two more of how it might crash, and then
that's true. That's a good point.
Really, 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 really behind. Okay.